Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como with Ireland Como Lavoy. I am repping my city's jersey today. Round two of the NHL playoffs today start for our Winnipeg Jets here in Winnipeg. Also, game two for Kane's Toronto Maple Leafs. I think he's the only Western Canadian still left cheering for them. But I guess if he's half our partnership here, then we got to, kind of be on his side a little bit as well. So I guess we'll cheer for the Leafs today. We'll definitely cheer for the Jets. Let's get into what is happening in ag markets. Canola had a pretty good day, up $7.60 to close at 701.30. That doesn't make any new highs or anything, and it was actually flirting with losses at one point during the day. Still a pretty good close for canola overall. Minneapolis wheat, a little bit concerning here, down 7.5 to 603. We'll talk about that in the charting section of today's video. Kansas City wheat down 8.5 to 529.5. Again, that's moving towards previous lows there. Chicago wheat down 1.75 to 534.25. Soybeans down 2 to 1039.25. Corn was down pretty big today, 6.25 at 449.25. We'll show a chart on that as in a bit as well. The Canadian dollar has been fading over the last couple of days. It's down below 72.5 now at 72.46. Live cattle took a bit of a breather, down 115 to 212.5. Feeder cattle also down marginally, and now at 298.60, or just over $2.98 a pound. All right. Today we're going to start off by talking about the Fed. The Fed stayed on rates today. They kept it at 4.25 to 4.5. Just a couple of talking points here. The U.S. economy is still growing at a decent pace. The job market is still strong. Unemployment is low. And inflation is still higher than they'd like it to be. We'll show an inflation chart here in a second. There's more on the flip side. There is a little bit more uncertainty now about where the economy is headed. I think there's still a lot of concern around whether we're going to see another quarter of GDP declines in the U.S., which would signal a recession. Two consecutive quarters of GDP shrink or negative print is the technical definition of a recession. The Fed is still slowly shrinking their balance sheet, which is selling off government bonds and mortgage-backed securities to tighten financial conditions. So that's something to do when they're a little bit more hawkish. They're being cautious, and we'll watch the incoming data like jobs and inflation, et cetera, before deciding on any future rate hikes or cuts. And they're prepared, of course, to adjust if things go sideways. So just to kind of show the inflation rate in the U.S. here, in January, it peaked for the calendar year at 3%. It had kind of been rising in from September to January, and peaked there, and then started to come back down. The last print was 2.4%. I would think that would be a pretty positive print and support further interest rate reductions. I know lots of people are hoping for interest rate reductions, including President Donald Trump. But I guess it's not to be at this point in time. I think they're just kind of, I think the market is just kind of looking for everything to settle down as far as trade and see where the chips fall before making continued drastic cuts to interest rates, things like that. So I think that pretty much covers where we're at with the U.S. interest rate. I think in Canada here, we're not necessarily dependent on where the U.S. goes. I think we're kind of leading the U.S. in interest rate cuts to some degree. But it does have an impact on our own currency as well as our own interest rate path going forward. So just thought I'd mention that. All right, let's get into the grain fundamentals here a little bit. Tomorrow is the Statistics Canada grain stocks for March the 31st. Expectations, I'll run through the expectations pretty quick here. We're going to give our premium subscribers a hot take or our take on what the numbers actually mean when they come out tomorrow. But just here's the expectations: 5.35 million tons of canola. That's pretty low. I'll show you a chart in a second. Wheat, ex Durham, 13.2. That's about pretty similar to last year. Durham wheat at 1.7 is a little bit below last year. Same with barley and oats, a little bit lower than last year. So overall, stocks tighter than they were last year. Canola significantly more drastically than the others. If you want to get access to our analysis after the data is released, you'll want to subscribe to our insights. Gives you everything that we put out, including all of our fundamental information, all of our fundamental analysis and research, and basically everything that we produce. That's only $99 per month. It's billed monthly. You cancel anytime. So if you try it out and you don't like it, you can cancel. No problem. You go to canadianagmarkets.com/subscribe. There'll also be a link in the description below. All right, let's continue on with that theme of canola stocks. So just to kind of illustrate where that 5.3 million lands in the grand scheme of things, what I think is interesting here is that we haven't seen stocks this low since March of 2013. So March of 2013 would have encompassed stocks from the 2012 drought. So we're dealing with stocks that are potentially in line with a pretty big drought year, which we can already see in the futures market that this market is signaling a tight supply. But that's still pretty tight, and we still got two and three quarter months left of this crop year, almost a whole quarter of this crop year yet to ship grain. So this is a pretty tight situation, particularly if it is in that 5.3 million ton area. The the gap in estimates, or the spread in estimates, was very wide. I think we were talking like 3.7 to 7.2 or something like that. I know the reporter for Reuters who aggregates all of these, saying that there's less and less people that are participating in providing estimates, so it is getting a little bit trickier for them. But anyway, these estimates were actually somewhat in line with my own estimates. So I would say the median is probably close to average. Where I will, or close to accurate, where I will caution is the last print that Statistics Canada made on canola was to cut production to 17.8 million tons. I guess it depends on what the on-farm survey results are like, but I guess there's a potential. I guess if there's a bearish potential in this market, it will be on a production increase from Statistics Canada. Based on the December survey of stocks, I would say that that's less than likely. However, sometimes memory changes over those 3 months, particularly in the farm community, and so they may start to report closer to actual stocks as opposed to what they want Statistics Canada to think they have. I don't know what the real answer is, but I guess if there was a bit of a bearish shock, it might be on Statistics Canada raising production somewhat. I could see them doing it up to a maximum of 500,000 tons at this point, although I think that's highly unlikely as well. Maybe 100 or a couple 100,000 tons. At any rate, I think that there's probably a production increase justified. That doesn't necessarily make me any less friendly to this market, or doesn't really make it actually makes the S&D work out better, because as we discussed in some of our reports previously, if we were to take face value the Statistics Canada production number and the current trajectory of demand, there would be zero ending stocks left at the end of the year. So something has got to give. We either have to start changing the trajectory of the demand, the crush, and the exports, or we have to start adding production back in. And so Statistics Canada may be able to do one of those three things tomorrow. All right, moving on to wheat. Wheat isn't as big of a decline, but kind of in line with the last 3 years. So we don't expect too many fireworks on the wheat. This is, of course, excluding durum. But still, it is a relatively tight situation. We do see that prevalent in the basis markets and things like that. So it is still tight out there in wheat, just maybe not as tight as what it is perceived to be for canola. All right, let's move on to some price charting today. Here is the canola chart. So I'm gonna talk a little bit on some risks here, because I think that they're important to watch out for. Canola did break below trendline support today briefly, traded down below 690 on the July. That is where the upward trend line is sitting at right now, is about right around 690. There is still the 20-day moving average kind of hanging out right now at 684. I think if we see a break below those two levels, that would be a concern. And why this is a bit of a concern for me now is when I look at the July soybean oil chart, and like canola and soybean oil have been pretty closely correlated. I'm not saying there's causation on one or the other, but they're relatively well correlated. And when we look at soybean oil over the last couple of days, yesterday, soybean oil broke below the 20-day moving average, tested the trend line support, and then rebounded a little bit. Today, it traded back underneath the 20-day moving average and below trend line support as well. That's a bit of a dead canary in the coal mine, so to speak. So we could see further weakness in the soybean oil just on some technical selling, and that may actually end up carrying itself over into canola. So I think it's important to watch that. Another oil seed that I think is important right now is palm oil, which continues to fade and make new lows today, or in the early parts of today, it made another new low, settling down at 3,718 ringgit. Earlier in the month, or in the last month, we were trading above 4,000 ringgit for most of the last, 30, 45 days. So this is a concern as well. We could continue to see this fade, even from a technical perspective, down to the 3,500 ringgit level. So, veg oils are just out of favor right now. I've showed a lot of crude oil charts in the last little while. I think that's a big part of it, is that the crude oil continues to fade, and that's putting pressure on the biodiesel side of it, which is correcting the veg oils. The palm oil fundamental situation is also getting a little bit looser and causing that to decline. And it's kind of one of those, when one of these markets catches a cold, sometimes the rest of them follow suit. I still think that canola is overperforming. That's because of the tight fundamentals, but overperformance doesn't necessarily mean that it continues to go higher. At some point, it could start losing, at a slower pace than some of the other veg oils. So something to keep in mind. I did want to put up a July soybean chart here. Something interesting is kind of happening here, as far as there's some consolidation that's happening here in the last couple of weeks. The 20-day moving average, though, is trending higher, and it has been breaking above all of these other, 50, 100, 200-day moving average. Tomorrow, we'll probably see a break of the 20-day above the 200-day. From a technical perspective, I always look at that as a positive, although we haven't seen that play through yet in the soybean futures. No new high, no break of channel, anything like that. But I just thought I would mention it because it is a bit of a watch out. We could be seeing some optimism get pumped into the soybean market as the U.S. and China and other nations are meeting, and the trade war concerns are moving lower. All right, corn had a bad day today. We did kind of move towards testing this previous low here at about 445. I would consider that very weak support at this point, and wouldn't look at that as a major pivot point. What I'm looking at right now is this 435 area, 436 area down here, where there was a consolidation of trade. Um, the the planting progress, the emergence, and just the lack of weather concerns right now, I think, are pressuring corn quite considerably. So something to keep in mind. Another thing that I think is starting to hurt the markets is the spring wheat planting progress and emergence, which is also ahead of planting pace. We talked about that yesterday in yesterday's video. We saw a big correction today in the spring wheat market. It's now trading solidly below the 20-day moving average. I think it's possible we see this, pick off another dime or 15 cents in order to get kind of down here into that 590 area. Although there is some nice support that's been built there, including from back kind of in December when it kind of moved in between $596. So I think there's support here. There just isn't anything to really rally this spring wheat market at this point. So just a bit of a cautionary tale there, as we may start to go back down and test previous lows again in this market. The other wheat markets aren't helping much, although we did see relatively flat trade today in Chicago wheat. It did move up and test the 20-day moving average today in this market and failed. It's, in the last, 2-3 weeks, it's had trouble breaking above that 20-day moving average, and it has been making lower lows. So again, kind of the definition of a bear market is lower highs and lower lows. And you can see, every time it makes a new low, it does so at a lower price point. Every time it makes a new high, it does so at a lower high point. So we could continue to see this fade and make a new low as well. That is not off the table. Kansas, kind of the similar story here. It's kind of consolidating in this area right now. So, not a whole lot of directional bias right now, but overall, still in a downward trajectory. So, I wouldn't necessarily trade against that at this point. The Canadian dollar is kind of slowly, eking out gains over time. As you can see, there was some volatility right around Liberation Day in the US. It kind of stabilized above 72 cents there for a while, and it's just kind of been grinding higher. It is now trading below 72.50. It did get up to 72.75 not that long ago. But overall, in the last month to 5 weeks, this has been kind of grinding higher as well. So that does tend to kind of put some pressure on our basis levels over time. Usually the bigger moves tend to create more reactionary reactions for our basis market, but um, overall, I just wanted to point that out as a trend that is occurring. All right, so that is all we have for you today. Thank you so much for tuning in. We appreciate, and make sure you subscribe to this YouTube channel as well as to our premium content. And we will see you tomorrow after all this wonderful hockey this evening. Have a great day.